Okay, so you want to own a diamond mine. You find a piece of land somewhere in Botswana, Canada, South Africa, or Angola. You drill into the ground, discover a deposit full of diamonds, build a mine around it, and start pulling millions of dollars worth of stones out of the earth. That's the picture. And compared with almost any other mining business, diamonds seem like they should be the ultimate cheat code. Gold is valuable, but it's heavy. Copper miners move enormous amounts of rock to produce something worth only a few dollars per pound. Iron ore gets shipped around the world by the millions of tons. A diamond is different. It can fit in the palm of your hand and be worth more than a house. Find one exceptional stone and you could be looking at millions of dollars in something small enough to lose in your pocket. So if you own the hole in the ground where those stones come from, surely you're sitting on one of the greatest businesses on earth. Here's the problem. A diamond mine can have diamonds underground, hundreds of millions of dollars of equipment above them, hundreds of people working around the clock, and still struggle to make money. Because having valuable diamonds in the ground and owning a profitable diamond mine are two completely different things. And right now, that difference matters more than ever. De Beers, one of the biggest names the diamond industry has ever produced, sold its rough diamonds at an average realized price of about $142 per carat in 2025. In the first half of 2026, that average fell to roughly $105 per carat as the market weakened and the mix of diamonds being sold changed. The diamonds didn't disappear. The mines didn't suddenly stop working. Buyers were simply willing to pay less for what came out of them. And when your business requires spending hundreds of millions, sometimes billions, of dollars before you know exactly what every stone underground will eventually sell for, that creates a very uncomfortable business model. So how does a diamond mine actually make money? And why can one mine become spectacularly profitable while another deposit, full of perfectly real diamonds, is better left untouched? That's the question. And the answer starts long before the first diamond ever reaches the surface. You don't start a diamond mine by buying a shovel. You start by spending money looking for something that might not even be there. Diamond exploration is basically an expensive search for geological clues. Most diamonds were carried toward the surface millions of years ago through volcanic structures called kimberlite pipes. Finding one of those pipes is exciting, but it doesn't mean you've found a mine. It means you've found a rock formation that might contain enough valuable diamonds to become one. That's a very different thing. So you survey enormous areas. You collect soil samples. You run geophysical surveys. You drill exploration holes. Then you pull long cylinders of rock out of the ground and send them away for testing. And after spending millions of dollars doing all of that, you may discover that the deposit contains almost nothing worth mining. Or there are diamonds, but not enough of them. Or there are plenty of diamonds, but most are low quality. Or the stones are valuable, but they're buried so deep that getting them out would cost more than you could sell them for. That's the first brutal lesson of diamond economics. A diamond underground isn't automatically worth mining. What matters is how many diamonds are there, what those diamonds are worth, and how much money you have to spend to find them, reach them, process the rock, recover the stones, sort them, sell them, and eventually close the mine. Change any one of those numbers enough, and the same deposit can go from fortune to financial disaster. Imagine your ore contains 1 carat of diamonds for every ton of rock. That sounds fantastic. But suppose those diamonds are worth an average of only $60 per carat, while moving and processing that ton of rock costs you $70. You just spent $70 to produce something worth $60. Every ton you process loses another $10. You found diamonds. You didn't find a business. Now flip the equation. Another mine might contain only half a carat per ton, but the diamonds are larger and higher quality, averaging hundreds of dollars per carat. That lower-grade deposit could be dramatically more profitable. And this is one of the things that makes diamond mining so unusual. An ounce of refined gold is basically an ounce of refined gold. Diamonds don't work that way. 2 stones can weigh exactly the same amount and have completely different values depending on their color, clarity, shape, quality, and what a buyer believes can eventually be cut from them. So a diamond mine isn't simply trying to produce the most carats, it's trying to produce the most valuable carats. That distinction shapes almost everything that follows. Now suppose the exploration results look good. There's enough material, the diamond quality appears strong, the geology makes sense, you think you have a real mine, you still don't have a business. What you have is a project that now needs an extraordinary amount of money. If the deposit is reasonably close to the surface, you might begin with an open pit. That means removing huge quantities of soil and waste rock just to expose the diamond-bearing material underneath. You need haul trucks so large an ordinary pickup looks like a toy next to them. Excavators, drills, crushers, conveyors, power infrastructure, water systems, workshops, fuel storage, roads, employee facilities. And then you need the processing plant, because diamond-bearing rock doesn't come out of the ground looking like a jewelry store display. The diamonds are trapped inside huge amounts of ordinary material. You have to separate one from the other. The ore is crushed, screened, concentrated, and moved through increasingly sophisticated recovery systems designed to find diamonds among all that rock. And that creates an interesting engineering problem. You need to crush the ore enough to release the diamonds, but you don't want to crush it so aggressively that you damage the exact product you're trying to recover. Because breaking one large diamond into several smaller diamonds doesn't simply divide the value into equal pieces, it can destroy a huge amount of that value. A single large stone might be worth millions of dollars. Break it in the wrong place, and a large part of that value can disappear in seconds. So the processing plant isn't just separating diamonds from rock, it's trying to do that without accidentally destroying its own revenue. Lucara's Karowe mine in Botswana shows just how important that can become. Karowe is famous for producing unusually large diamonds, including stones weighing well over 1,000 carats. In 2025, one 1,094 carat stone entered Lucara's sales arrangement with an initial polished value of $12 million. Think about that. One stone moving through your recovery system can materially change the revenue of the business. That's the exciting part. Here's the uncomfortable part. You don't know exactly when those stones are coming. If exceptional diamonds show up more often than expected, the mine can have an extraordinary year. If they don't, revenue can look very different even if you processed almost exactly the same amount of ore. That's the strange lottery hidden inside an industrial operation. You can estimate the grade. You can model average diamond values. You can forecast production across millions of tons. But you cannot schedule the discovery of a $10 million diamond for next Tuesday afternoon. And underneath all of this is the cost that slowly eats at every mining operation if management loses control of it. Moving rock. A diamond mine is really two businesses stacked on top of each other. The first is the business everyone notices, recovering diamonds. The second is the one consuming most of your machinery, fuel, labor, and time, moving enormous amounts of material that are not diamonds. Imagine your plant processes 2 million tons of ore in a year. At an operating cost of $25 per ton, that's $50 million. And that's before corporate overhead, before interest, before taxes, before replacing major equipment, before expansion, before mine closure. Karowe reported operating costs in the mid-$20 range per ton, processed during parts of 2025 and 2026, which gives you some idea of how quickly a small number per ton turns into a very large annual bill when you're processing millions of tons. And that bill doesn't disappear because diamond prices had a bad month. Your trucks still need diesel, your plant still needs electricity, your employees still need to be paid. Your pumps still have to move water, your maintenance crews still have to replace worn-out parts. Once a mine is running, it develops a very large appetite for cash, and it needs to be fed every day. Now here's where the economics become even more difficult. As an open pit gets deeper, the geometry starts working against you. You can't just dig a narrow vertical hole straight down to the diamonds. The walls need safe slopes. Roads have to spiral down into the pit so enormous trucks can reach the bottom and climb back out again. The deeper you go, the more waste rock you may have to remove just to reach another layer of valuable ore. Eventually you can reach a strange point. The diamonds are still there, but the open pit no longer makes economic sense. So now you have a decision: close the mine, or go underground. And going underground isn't just continuing the same operation a little deeper. It's almost like building another mine underneath the first one. You need shafts, ventilation, underground tunnels, material handling systems, electrical infrastructure, water management, emergency systems, and years of construction before the deeper ore starts generating meaningful revenue. Lucara has been making exactly this transition at Karowe, investing in an underground expansion designed to extend the life of a mine that has already produced some of the world's most remarkable large diamonds. And this is where mining becomes a capital trap. Your mine may be profitable today, but if you want it to keep operating tomorrow, you may have to spend tomorrow's money today. Hundreds of millions can go into an underground expansion years before that investment produces the diamonds needed to pay it back. And if diamond prices fall while you're halfway through construction, there's no easy way out. You can't return an underground shaft because the market changed. The money is already in the ground. Now we finally get to the product itself, the diamonds. And this is where you might expect the easy part to begin. You found them, you recovered them, now you sell them. Except diamonds don't come out of the ground with price tags attached. Rough diamonds have to be sorted by size, shape, color, clarity, quality, and what experts believe the polished stone might eventually become. Some are worth very little. Some are suitable for ordinary commercial jewelry. Some are extremely valuable. And every once in a while, a mine produces a stone important enough to be sold almost like a work of art. This is why average price per carat can be misleading. Imagine mine A produces 100,000 carats at an average value of $100 each. That's $10 million in revenue. Mine B produces only 30,000 carats, but its diamonds average $500 each. That's $15 million. Mine B produced less than one-third as many carats and generated 50% more revenue. So production volume alone doesn't tell you very much. The mix matters enormously. A mine can produce fewer diamonds and have a better year because the stones happen to be more valuable. Or it can hit its production target and disappoint investors because the mix was weaker than expected. De Beers' own realized prices can move significantly, not only because the diamond market changes, but because the mixture of higher value and lower value stones being sold changes. And now we reach one of the biggest risks in the entire business. Your customer doesn't actually need your product. Copper goes into electrical systems. Iron ore becomes steel. Oil becomes fuel. And petrochemicals. Gem quality diamonds are different. Most of their economic value exists because people believe rarity, beauty, tradition, and emotion make them desirable. A diamond mine ultimately depends on something no excavator can control: what people want. For decades, that worked extraordinarily well. Natural diamonds became connected with engagements, marriage, status, luxury, and permanence. But the industry now faces a competitor that changes the equation: lab-grown diamonds. Chemically and physically, they're diamonds. But instead of waiting for geology to create them deep underground and then spending enormous amounts of capital digging them out, manufacturers grow them using industrial technology. And as that technology improves, their prices can fall dramatically. Now compare the two business models. Your natural diamond mine might require years of exploration, hundreds of millions of dollars, huge trucks, a processing plant, hundreds of workers and contractors, permits, roads, power, and eventually an expensive closure program. Your competitor needs a factory. That means natural diamonds can't compete simply by saying ours sparkle and theirs don't. They have to sell something the factory can't reproduce as easily: natural rarity, origin, history, emotional significance, the idea that the stone took billions of years to form beneath the earth. And that's what makes this business so unusual. A diamond mine is partly a geology business, partly a heavy industrial operation, and partly a luxury marketing business. If that last part weakens, the pressure eventually travels all the way back to the mine. De Beers' average realized price fell to roughly $105 per carat in the first half of 2026, down sharply from $155 per carat in the comparable period of 2025, while the company continued adjusting production and inventory to weaker trading conditions. Think about what happens to the mine. Your selling price falls, but the truck doesn't suddenly cost less to operate. Explosives don't get cheaper because jewelry demand weakened. Workers don't accept 30% less pay because diamond prices had a bad year, and the underground project you started 3 years ago still needs money. Revenue gets squeezed from the top while much of the cost base stays exactly where it was. That's when weaker mines get exposed. Because here's one of the strangest truths in mining: not every diamond in the ground should come out of it. Sometimes the smartest thing a diamond company can do is leave perfectly valuable diamonds exactly where they are. That sounds ridiculous until you do the math. If it costs you $120 to produce a carat that you can only sell for $100, producing more doesn't rescue the business. It kills it faster. A $20 loss per carat multiplied by 1 million carats is a $20 million problem. More production is not automatically better. More profitable production is better. That's why mining companies sometimes deliberately reduce output during weak markets. The mine may physically be capable of producing more. Management simply decides that spending more money to push more low-value diamonds into a weak market doesn't make sense. And then there's one more cost that almost nobody imagines when they picture owning a diamond mine: closing it. Mining is one of those businesses where you need to think about how you're going to dismantle the operation before you've even finished building it. Eventually, the economic ore runs out. And when that happens, you don't just lock the gate, hand someone the keys, and walk away. Pits, waste rock areas, water systems, roads, buildings, processing facilities, and disturbed land all have to be dealt with under environmental and regulatory requirements. Rio Tinto's Diavik mine in Canada's Northwest Territories is a perfect example. After more than 23 years of operation and over 150 million carats of rough diamond production, Diavik reached its final production in March 2026. But the end of production isn't the end of the project. Closure activities are expected to continue through 2029, followed by post-closure monitoring. Think about the financial structure of that. The diamonds stop coming out. Revenue moves towards zero. But people are still working. Equipment is still operating. Environmental work is still being done. Money is still leaving the business. The final bill was built into the mine from the beginning. So after all of this, what separates a great diamond mine from a terrible one? Usually it comes down to a handful of structural advantages. The first is ore quality. If your mine consistently produces more valuable diamonds, you have more room for error when costs rise or the market weakens. The second is cost control. A few dollars per ton doesn't sound important until you're processing millions of tons every year. Save $3 per ton across 2 million tons, and you've just saved $6 million. The third is mine life. A billion-dollar processing operation makes much more sense if you can spread that investment across decades of production instead of a few years. The fourth is financial strength, because sooner or later, this industry will give you a bad year. Diamond prices fall, fuel gets expensive, a construction project runs over budget, production misses its target. The operator that survives isn't necessarily the one that had the best year when prices were high. It's the one that still has enough cash when conditions turn against it. And then there's the fifth advantage, the one almost no other mining business has. Exceptional stones. A copper mine doesn't suddenly discover one magical piece of copper worth $20 million. A diamond mine can. Karowe has built much of its reputation around exactly this phenomenon, recovering multiple enormous diamonds, including the 1,758 carat Sewelo, the 1,109 carat Lasidi La Rona, and the 2,488 carat Motswedi. One extraordinary stone can create extraordinary upside. But you can't responsibly build your entire business plan around the assumption that another record-breaking diamond is sitting behind tomorrow's blast. And that's the paradox at the heart of this industry. The thing that makes diamond mining so exciting is also the thing you can't reliably predict. So after all of this, what does owning a diamond mine actually mean? It means spending enormous amounts of money proving that something valuable exists underground, then spending even more money building the machinery required to reach it, then moving millions of tons of material to recover a tiny quantity of product. Then, sorting that product almost stone by stone because two diamonds of identical weight can have completely different values. Then, selling those stones into a market where demand depends partly on economics and partly on human emotion. And when the mine finally runs out, you keep spending money after the revenue starts disappearing. Physically, the diamonds are almost the smallest part of the entire operation. Financially, they control everything. That's the real economics of owning a diamond mine. The business isn't find diamonds, sell diamonds, get rich. It's finding the right deposit with the right grade, containing the right quality of stones, building the mine at the right cost, recovering those stones without destroying them, selling them into the right market, and keeping the selling price above your cost for long enough to recover everything you spent getting there. Because a diamond may be forever. A profitable diamond mine absolutely is not. And that may be the strangest part of the entire business. You can stand above billions of dollars worth of diamonds and still own a terrible investment. The wealth isn't created when geology puts diamonds in the ground. It's created only when you can pull them out for less than somebody is willing to pay for them. Everything else is just very expensive rock.